Hello and welcome back to Core Finance. I'm Matt Brown, joined by Connor Campbell, who is a financial analyst at Spreadex, and we're going to look at three stocks in the UK that are reporting this week. Starting with, a stock that hasn't performed that well this year, almost down 20% year on year. Stagecoach. Do we like them? Should we like them?
It's interesting. Sort of the picture sort of significantly changed last week. Like beforehand, if you hadn't removed that, then things were looking pretty bad, and maybe all you'd be looking for would be a bounce off of its lows. Really, like back in September. In the middle of September, that was 8-year lows. That's how badly it's doing at the moment. And main issues being sort of its East Coast franchise charges and sort of things related to that. They dragged, I think it was down 83% full year pre-tax profit back in June. And even when you strip that out, full year pre-tax profit still fell 15%. So it's not like if you strip out the East Coast franchise, Stagecoach is suddenly doing incredibly well. In September, its figures were fine, but not enough to sort of mitigate the fall that it's seen back in June. I think the UK bus division was the main issue. I think it was down 0.1% in the country. Like-for-like was down 0.1% in the country as a whole, 0.4% in London. On the rail side of things were okay. I think UK rail sales, excluding South West Trains, which they lost the contract for earlier in March, again, that's a bit of bad news. They were up, I think, 3.6% or 3.8% or something like that, like. And then a Virgin Rail Group, which owns like 49% of, I think they're up like 4.4%. However, so it was doing fine, not great. But then, the Department of Transport announced their new vision for the future, the way they're going to overhaul railways, blah blah blah. Main focus for Stagecoach was that the East Coast rail franchise is now going to be like an East Coast partnership, sort of like a public and private partnership, whatever. The main focus is that ends that contract like 3 or 4 years early. And given that Stagecoach has said in June that franchise wasn't going to be profitable until 2019,
it's got to be
that contract being cut is fantastic. It jumped like 13% on that news alone. Like, I think investors were just relieved that that is going to be taken off their hands. And I think the government only did it to save face, really, and to prevent another private company being like, we don't want this, basically. Other good news, it was on the shortlist. It's been put on the shortlist, for the HS2 high-speed railway. Yes. I think it's that and First Group and maybe something else. But again, that was a very, very good update from the Department of Transport, specifically for Stagecoach, specifically because of that, sort of the end of the East Coast nightmare, basically. The downside to it is, I'm not sure quite how much good news it's going to be able to produce on Wednesday. It's seen that really sharp jump last week. It's now sort of, has it used up the bounce it could have seen following its numbers on Wednesday? Because before that, we were seeing our clients buy around the 160 mark. I think, fishing about at the lows, looking for some kind of glimmer of hope. Well, that hope has been and gone now. So I'm not quite. We've seen clients now come in and start selling at the 180 mark, just because I'm not sure if it has got the momentum with its own figures to build on that jump. And that jump was so sharp that it could fall back to the 170 mark, still have seen a decent bounce on that Department of Transport update, but be back to more realistic figures based on how it's done.
So it's important when the numbers come out, if they do disappoint, you'll probably see a lot of profit taking from those that have picked it up around let's say the 150, 160 level. If, however, a good set of numbers with a bit of strength and some positive expectations, then that could continue.
I think, because I think the thing is, Stagecoach's their own outlook now could be significantly changed, just because they can be like, when you strip away the East Coast thing, when we've got this and this, it's safe. They can, those UK like-for-like bus figures in September weren't great, but they also weren't bad. Like-for-like's been down 0.1%. That can easily turn around in a few months. And the UK like-for-like rail figures were decent, so there are signs. There were already signs of positives in September. That now, with sort of the East Coast situation, far and away improving far more than I think investors could have hoped for, it could be a decent update on Wednesday. I think just the only danger is it jumped so sharply on the Department of Transport news that I'm not sure how many people are willing to barrel into it now that it's jumped 20p or something. I don't know.
Good stuff. And next stock, DS Smith, not a stock I typically trade. Is this one popular with clients? Maybe I've missed out on this one this year.
It's going to be added to the FTSE 100 in the next reshuffle. I think it's effectively taken on Merlin Entertainment slot. It's one of the movers with Just Eat. It's up 32% this year. Our clients, even though how that 560 or 565 it hit, I think last week, that was an all-time high. But our clients are still buying into this. I think it's just a stock they want to own. But you look at the figures and. It's easy to see why. I think full year figures back in June, revenue was up 18% to 4.78 billion. Pre-tax profit was up, I think it's 31% to 264 million. So that's impressive in and of itself.
Good, yeah.
During that same update as well, it announced it bought an 80% stake in Interstate Resources, which is like a corrugated packaging and paper packaging company, for 722 million pounds, with an option in 5 years' time to buy the other 20%, basically. Now that's important because that's its first step into the US market. It's already seen success in Europe. In its updates in September and October, it was saying how strong volume growth was across Europe. It's very happy with how it's doing. And that step in the US, I think investors really want to hear how much has Interstate contributed in the last few months since its updates in September and October. And it's just sort of a sign of ambition, really. It's taken those steps into America in maybe a sensible way as well. It's not gone and completely bought out a company. It's bought 80% stake. So it's not, it's slightly hedging its bets in that regard. In terms of its half-year figures as well on Thursday, they're continuing to, even if it doesn't provide a substantial update on Interstate, sales are still meant to be up 10% to 2.6 billion, and operating profits expected to be up 7% to 240 million. So that's very healthy figures.
Yes.
Again, the only danger is that it's very high at the moment, and it's climbed quite sharply since, I guess, the middle of October. But I guess it's pulled back a bit. It's at the 540 mark. After the half-year figures on Thursday, it could just return to the 560 mark, and I think our clients will be happy. Like I said, despite how sharply it's risen, our clients are very, very firmly behind the stock. I think it's just a stock they want to be into. They're really excited about at the moment, even if it does pull back after the half-year figures on Thursday. The strength of its numbers in the last few updates are as such that they're willing to sort of ride any bumps in the road out.
Well, the fundamentals all sound good. Good luck to DS Smith reporting this week. And finally, let's have a look at Berkeley Group. Bit of a roller coaster year, but up on the year.
It's interesting. It's still up 36%, despite what looks like a fairly ugly. I guess even just in September, fairly ugly movements. Again, sort of like DS Smith, its full year figures back in June sort of explain why it's risen 30% this year. Pre-tax profit was up 53% to 812 million, that's huge, and revenue was up 33% to 2.7 billion. Very healthy figures. It's on track to hit its 3 billion in pre-tax profit across the 5 years by the year ending in April 2021. That's sort of been the main driver of growth. The fact that 53% full year jump is in pre-tax profit. It's hitting those figures. It's showing no signs that it's going to miss that. However, in September, it sort of warned that. The London property market is still struggling with Brexit uncertainty, and the relatively recent stamp duty changes. That's been an issue. Then, since October and November, you've had Barclays come out with sort of a sector-wide downgrade, saying that I think their exact words were that expectations matter, which again doesn't bode well for a stock that has jumped 36% this year. Then even stuff like the budget. The budget was pretty pro house builders. I think the total figure earmarked for all of their various schemes was like £44 billion over the next 5 years, and they're going to have the 300,000 new homes built a year by the mid 2020s. However, then there was that sort of comment about the compulsorily buying.
Land
banks and stuff, if companies weren't building on them for commercial rather than technical and practical reasons, and that's all spoilt the update, I think, in the eyes of the house builders. It's bounced back a bit. It's fairly mixed from our clients. I'd say they're buying around the 38.50 mark, just because of the fundamentals are incredibly strong, and there's no real reason why that's going to have changed in its half-year figures on Friday. But there are enough speckles of doubt, the London property market and those potential issues with what Hammond announced in the budget, to make people, think a bit, maybe a bit like we'll buy it, but not. I would just say that they're not buying with anywhere near the level of enthusiasm that they are with DS Smith. It's very much a cautious buy rather than a wholehearted, we want to be part of this stock, just because it's a sector that seems to have constantly beaten. Every time there's like a hint of a slowdown or something, then the house will just sort of keep going. And I guess there are questions of, well, how long can that last? Heading into 2018, that is likely going to be even more difficult than 2017 has for the UK economy.
Well, on that note, Conor Campbell, thank you very much for
Thanks
joining
very
us
much.
today.